2014. Let's quickly go around the room, introduce ourselves for the record.
Good morning, everyone. Rosemary DeBellis, representing the Police Commissioner.
Dan Torelli from the PBA.
Joe Alejandro, PBA.
Chris McGrath, PBA.
Bob Ganley, SBA.
Steve Birbiglia, LBA.
Chris Monahan, CEA.
Michael Palladino, DBA.
Bob North, Actuary.
Yvonne Nelson, Controller's Office.
David Dieter, Controller's Office.
Martin Gantz, Controller's Office.
Savvy T, Controller's Office.
Scott Stringer, Controller's Office.
Seema Higurani, Controller's Office.
Susanna Vickers, Controller's Office.
Janice Emery, Mayor's Office, and I also have the proxy for Commissioner of Finance today.
Bob Sanskistad, Pension Fund.
Kevin Holleran, Pension Fund.
Nicole Jambrisi, Pension Fund.
John Lewis, Controller's Office.
Brian Burke, Controller's Office.
Christopher Pop, Controller's Office. John Mercerberg, Controller's Office. Mike Jacobowitz, Pension Fund.
We're missing anyone?
And Barry.
And Barry.
And Barry Dennis from SIS.
Okay.
Okay, welcome everyone, and let's just turn it over to the Controller. We have the privilege of having the Controller here for the first time, Scott Stringer.
Thank you very much. And it's really an honor to be here today, and I really look forward to working with all of you to safeguard and grow our assets in the New York City's Police Pension Fund. And I know you know this, but let's put on the table, we need to protect retirement security to make sure that the New Yorkers who risk their lives every day on the job know that their pensions are protected. And I want to work with each and every one of you to that end. And part of why I'm here today is to make an introduction so you can get to know me. My phone and my email is available to you directly. I want to make sure that we build the trust and the relationships that's necessary. I look forward to working with the new police commissioner and our new mayor. We are in this together. I've been on the job for 7 days now, and I want you to know the money's good. So far, so good. But I will tell you that I'm gratified to report that the pension plan assets grew from $20 billion at the end of 2009 to $30 billion last October. And that's a great testament to the Controller's Office and to all of you who are really following the money. And I hope that we can do better and we can grow this fund in the most responsible way. I am proud to report that Seema is going to stay at least for another 6 months. We announced that, so we're going to have a seamless operation going forward, and I'm really glad that you're here. I do have some sad news, however. Thad, who I've only worked with for 7 days, is going on to bigger, not necessarily saying better things, and he's going to be leaving us, but the kind of person he is and his love for city government and this pension board, he's agreed to stay on for as long as necessary as we begin to groom his successor. And I want to recognize the person who will be replacing him, who's already started that process, and that's Susanna Vickers, who's been with me when I was in the Assembly and as borough president. She's the person in my office who's worked with me the longest. She got her first job with me at least 15 years ago. She started at the age of 14, and she's been with me ever since. But she's somebody I trust completely. She's honorable, transparent, and wicked smart, and I think you're going to really enjoy working with her. And I just want to congratulate Thad for putting so much into this. To the people I'm getting to know in the Controller's Office, one thing that struck me in the last week is the kind of professionalism and the kind of passion they have for doing this job. So together I just look forward to working with all of you. Many of you I know for quite some time, and please understand there's real mutual respect around the table. So I thank you, and I just wanted to come by and introduce myself. And again, you can always call me directly. We can have that kind of relationship going forward.
Great, thank you.
Thank you.
Welcome.
Thank you. Thank you very much.
Thank you.
Okay. So with that said, I'll turn it back to you.
Okay.
And I'll leave it to your business.
Seema.
Okay. All right. Thank you very much.
Good luck. Thank you.
So Martin's going to pass out some handouts. As you know, we've transitioned to State Street, and so there's a little bit of some back and forth that we need to figure out with State Street as we make our way through this transition.
Now, State Street is now the custodial bank.
Correct. Yeah. So some pages will look familiar, some pages will not look familiar. We're trying to work this out with State Street as quickly as we can. part of that is, I apologize, the page numbers are not numbered, the pages are not numbered. So we'll make our way through. Let's see, is everybody have a packet? We're good? Okay, so again, we'll get through this fine. We'll just move around some pages but cover the important highlights that we generally do every month. So this first set of slides are the economic indicator slides. I'm not going to go through these. We have a great speaker coming on next from JP Morgan who's going to spend a lot of time talking about economics, where we are today, give you some sense of what 2013, some things we saw there and what to look forward to in the next year. So I'm going to skip through these. So right behind this set of slides is the market indicator page, which is November numbers. So this hopefully looks familiar to you. So just to go through some quick numbers here, because again, we're in January and we're talking about November numbers. But they were good, so I'll go through some of the highlights. So in November, the Russell 3000 was up close to 3%. IFA was up about 80 basis points. Emerging markets was down about 155 basis points. Core plus 5 was down about 60 basis points. High yield was up about 30 basis points. And tips were down about 1.2%. Now if you turn to the next page, this is the December numbers. And the Russell 3000 up about 2.6%. IFA up about 1.5%. Emerging markets down 1.44%. Core plus 5 down 60 basis points. High yield up about 50 basis points. And tips down 1.5%. So if you put that all together, you go to the next page, and this is a new page. Looks different. We will, again, come back and work on the other pages that we're more familiar with. But in any case, if you scroll down to the second to the last row, you can see that in November, look at
It's got
it's pretty bad. Look at the trailing 1 month column. Go down all the way to the bottom, you see total police. So November, the police pension fund was up about 1.5%. So very strong number. Fiscal year to date, 2 columns over, the police pension fund is up close to 10%. Now again, that's through November. So we just went through the December numbers, which if you factor in all that I just read out, police is up about another % in December, which would then mean that fiscal year to date through December 31, the police pension fund is close to being up 11%. So that's a very strong number. And again, JP Morgan will come in and give us some thoughts on what's going to happen this year, but so far so good. If you then turn to this page, this is an asset allocation page that you've seen before. And all this is showing here is that through November, and I can tell you that through December it's looking about the same. You might remember we took advantage of the strength in the U.S. equity markets. We were overweight. We were above the range. We were well below the range on Core plus 5. So we rebalanced during that time period. And you can see now in the green bar to the left and then the blue bar to the right in the fixed income column, we're now within the ranges in U.S. equity and Core plus 5. So we're well set up there as we go into the new year. And that's really all I wanted to cover now, given the set of slides that are in front of us. Are there any questions about what we just talked about?
Just to answer, obviously, there was questions about the hedge fund portfolio. There was questions about the hedge fund portfolio.
Yeah.
Can you just go over that real quick? Because it was in the newspaper.
Oh, right. Yeah, sure. So the numbers for hedge funds for police.
So click on the second page. last page.
Okay, so let's go back to fiscal year to date through June 30, 2013. So fiscal year 2013, your hedge fund portfolio was up 9.2%. This is all net of fees. And the benchmark, which is our HFRI fund of funds plus 100 basis points, was up 8.4%. So in fiscal year 2013, the fund did quite well. Now, we talked about how when we went into the majority part of 2013, we were out of balance in the sense where we've always wanted to try to get toward this 50-50 balance between return drivers in the portfolio and diversifiers in the portfolio. Now, given the strong equity markets in 2013, we were underweight those return drivers. So in many of those, as you might remember, are event-driven strategies, much more equity sensitive than credit sensitive. Now, we do have a couple of those funds now in the portfolio, Perry Capital being one of them, Fir Tree being another, but they hit much later in the year in 2013 because we had continued to meet with managers, but just not finding as many that fit our investment objectives as quickly as we wanted. Now, we have some more to bring to you in the coming months as far as return driver goes, but that's what you see now in the numbers as of fiscal year to date for 2014. So now the numbers turn a little bit in terms of being underperforming now the benchmark. So for police, the hedge fund portfolio, this is estimated fiscal year to date as of 12/31/2013, it's basically flat. And the benchmark, the HFRI fund of funds plus 100 basis points, is up 3%. And that's the differential that we're seeing, is that we're underweight these return driver strategies in the portfolio today, but that's not going to be the case going forward. And it was all a matter of, we knew we were going to be out of balance as we were trying to get this portfolio put together. And unfortunately, in a very strong up year in the equity markets, that's what happened to us. So that's fiscal year to date for 2014. But as I mentioned, we plan to bring a couple of these new funds to you in the coming months that will help balance out our portfolio.
Correct.
Any other questions? No? Okay. So I would like to bring in J.P. Morgan. You guys good with that? All right. I think they're outside. So just as an introduction, Mike Sembolis is here today from J.P. Morgan. He is the chairman of Market and Investment Strategy for the Asset Management Division, which manages about $2.2 trillion. And he's been at J.P. Morgan since 1987, so he's been there quite a while. And there he is.
Seema, did you just introduce Mike?
Briefly, but
All right.
I'm sure you have more to say about him.
Sure. Just for the reporter, I'm John O'Shea,
Thank you.
the SHEA. And this is Michael Sembolis.
Thank you.
And he's in the back. So thanks, everybody. Thanks for having us in, Seema and the team. I'm John O'Shea. Really quickly, I'm what's known as a client advisor from J.P. Morgan on the asset management side of J.P. Morgan. I've been working with the New York City retirement plans for the better part of the past decade, and very much want to say thank you for the relationships that we have, which largely revolve around private real estate and private equity. Michael Sembolis to my right, as Seema just mentioned, he is the chairman of Markets and Strategy for broad J.P. Morgan Asset Management, and that represents just over $2 trillion. Interestingly for us, that $2 trillion is all actively managed, so there's little to none in terms of passive strategies, and that's across all the different asset classes, which plays into today's thoughts as Michael, in his role, does a couple of things. One is he's a member of our investment committee. That's a committee of senior investors who oversee the existing books of business where we invest across the globe, all the different asset classes, to try and gauge how are they performing, how is their capacity, how are they resourced, and what new ideas are they trying to bring to markets and strategies. All of what Michael does finds its way into thought pieces like the one that's in front of you to help put the world in perspective for clients, both on the institutional side as well as on the private bank side. The piece that you have in front of you is one of the most widely read pieces that we produce that looks out over the next coming year with perspective over the past year. It's called Eye on the Markets. He also produces, it's about a twice a month piece. If any of you are interested in being put on that distribution, just let the team know, and I will make sure you receive it. So, in being asked to be here today, as this piece does, we were asked for Michael to give his thoughts on the markets, and so for the next several minutes he will. But I would invite, and Michael would invite any of you to ask a question along the way. Happy to focus on those items that you'd like us to focus on. Mike, coming off a great year, the world is still growing. Less obvious risks than there were last year at this time. Still risks?
You basically have covered it now.
Yeah, okay. Thanks for the time.
Yeah, last year was, there's only one other year like last year where profits growth and economic growth were slowing and the markets went up a lot. We had a feeling last year would be a pretty good year, even though the economic and the payroll and the profit data wouldn't look that good. It's going to be harder this year. It's going to be harder to get decent market returns without some confirmation that things are healing. The good news is most of the leading indicators we look at in the United States and Europe and Japan are getting better, whereas the emerging markets world still has quite a few problems, some of which I think are going to get worse in 2014. But most of the news that we see in the U.S. and Europe are looking much better, which is a good thing, because towards the end of last year, profits growth and economic growth slowed pretty sharply in the U.S. and a lot of other places. So at the end of last year, I think it was the widest gap I've ever seen between the optimism that financial markets were pricing in and the facts on the ground. And that's what drove us to, we do some artwork each year on the cover to help employ artists. And that's the point of this drawing, which is, the markets have kind of zoomed ahead. And the most disciplined investors that stuck to their asset allocations have made a lot of money, and people, there was a laundry list of things that people have been concerned about, worrying too much about what about inflation, what about the U.S. fiscal situation. Those are not front burner issues as far as the markets have been concerned over the last couple of years, and the cyclical improvement in profits and low interest rates have driven a lot of risk taking. So this is a year where I think the gains are going to be harder to come by, but will be substantiated by mid-year once we start to see. I think the U.S. is going to be growing at about 3% by June, and we'll start to see profits growth back at 10 to 12% in the U.S. and Europe, and expecting 8 to 12% returns on equities this year, 7 to 9% on hedge funds and diversified real estate and things like that. And not much, if any, contribution from cash, short duration, fixed income, or probably not much from high yield either. So, but that's the next couple months are going to tell us a lot in terms of whether or not we're going to get some follow through. Some of the data that we look at are pretty promising. Remember, last year was the biggest fiscal drag in the last 50 years. It was either the first or second most fiscal austerity the United States has been subject to. So you take that away, because last year we had portable health care taxes, we had increased personal payroll taxes and income taxes, and so you take that away, and this year you have less fiscal austerity, and housing's getting better, consumption's getting better. Household balance sheets in the United States are finally back to where they were in the early 90s. So it's been a long journey of household balance sheets taking on too much debt and coming back down. But when you look at household debt service to income, it's all the way back where it was in 1991. And so obviously there's differences by region and things like that, but broadly speaking, there's no more drag on economic growth from people continuing to have to pay down debt. And so that's a positive thing. And the U.S. has a remarkable energy advantage versus the rest of the world, and which we have. Our electricity prices here are generally half of what they are elsewhere. We're starting to see a gradual repatriation of lost manufacturing jobs. It's slow, but it's steady and it's visible. Natural gas is a fraction of the cost here that it is elsewhere in the world, and again, that translates not only into job growth, but more importantly into lower energy costs. And so a lot of those things have conspired to put the U.S. in a better position. Last year, in the beginning of the year, that's why we had the U.S. as our largest strategic position, and that worked out well, and I think that's the same position we're going to be sticking to this year. The Fed is going to, as everybody knows, they're going to slow the rate of their asset purchases. I'd be surprised if we saw long-term interest rates go up by more than 30 to 40 basis points. There is a massive community of defined benefit plans who are waiting for the moment where they can start to reload and purchase more fixed income. Most of the corporate defined benefit plans are simply interested in defeasing and locking down their plans and would like to de-risk as soon as possible. So there's a lot of buying power waiting for 30 to 40 basis point backup in long-term interest rates, and so I'd be surprised if we saw rates move much higher. The Fed probably won't raise short-term policy rates, my view is, until 2016. So depending upon what kind of business you run and how your own personal and corporate balance sheets are structured, that's either great news or terrible news. But the Fed has a story, they're sticking to it, and they believe a low cost of money is generating more positive things than negative things.
You say bad news because short-term rates won't return the majority of investors with any money in modern markets or anything.
Yeah, I mean, there are a lot of households, particularly retirees, who worked hard for 20, 30, 40 years and anticipated being able to retire and not have to take a lot of investment risk, and that they would be able to live off of the cash flow coming from a bond market and cash money market accounts whose real returns were positive. In other words, interest rates at or above the rate of inflation. Right now, interest rates are either flat or below the rate of inflation, and so in individual families are kind of being forced to draw down principal or radically increase the amount of risk they take in portfolios, neither of which is a great solution. But the Fed's aware of it, and they believe that the benefits from low interest rates outweigh the costs. And so they'll be sticking to that for at least, I think, another 2 years.
So the U.S. looks good?
What does that mean for the U.S. equity markets?
I think the bulk of what it's meant for the equity market's already done, right? I mean, the opportunity cost of cash has been so painful that it has already pushed a lot of hedge funds, households, and others back into the equity market, whereas maybe a couple of years ago, after 40% declines over the prior decade, you had people that were skittish. And one of the express purposes of low interest rates was to, forgive the phrase, but to bum rush people into stocks. And the Fed's been very clear about that. They call it the portfolio rebalancing channel because they want to give everything a very technical scientific name. But their goal was to get people, anybody, corporations, individuals, households, endowments, foundations, pension plans, reinvest in the equity market because they believe that higher stock prices engender greater confidence, hiring, inventory growth, payroll growth, etc. I think that process has largely played itself out.
So this year the markets are at what, 5%?
Yes, and not from multiple expansion, mostly from actual earnings growth. Last year was kind of remarkable. If I can just show you, if you just turn to this first page. Last year, the first two charts are telling you what happened with profits growth and GDP growth in the U.S. and globally. Last year was kind of not very much of a fun year, and yet, as shown in the third chart, global equities went up anyway. And so when equities are rising, even as the facts on the ground aren't so good, that's one of the signs that you're starting to see households reinvest in the equity market as part of a rotation out of fixed income. So I think that process has largely played itself out.
Is there more opportunity in the European stock market or emerging markets? Where are the opportunities for making money in 2014 in the equity market?
Well, I wouldn't necessarily call a 10 or 12% return on large, small, and mid-cap stocks in the U.S., a bummer. I mean, that's still pretty.
30.
What's that?
It's not 30.
It's not 30, but over the course of decades, the real returns on equities have ranged pretty consistently, looking at 20-year periods, between 5 and 7%. Right, so the real return on stocks, 5 to 7%. So if we get 10 to 12% this year in an environment of low inflation, that's still a good year. Europe is like a guy falling down the stairs, and he hits the pavement, and he's not falling anymore. And so you're finally getting to the point where the European data isn't getting much worse. And so the markets are taking comfort in that. I think this will be a good year for European equities, but it's going to be confusing to watch because you're going to still see 24% and 26% unemployment rates in Spain, deteriorating bank balance sheets in Italy, etc. But corporate profits are beginning to get a little better. And so the markets will probably anticipate better news ahead in Europe. I think Europe still has tremendous problems. So this would be the last year. We were optimistic on Europe last year, and we think Europe will do okay this year. But by the end of this year, I would expect us to want to reduce positions. The U.S. I mean, let me just show you one chart just so that you'll get a sense. Look at page 7. If you look at page 7 on the bottom left, this looks at household and corporate debt levels. And, the U.S. over-levered itself and paid a price. We had a pretty steep recession, but those debt levels dropped sharply but have now stabilized. This process is just starting in Europe. And so I'm much less convinced that what's happening in Europe this year is the beginning of a long Renaissance type recovery, and I think it's just a relief rally. And 2015 and 16 are going to bring some of the structural problems back. Take a look at something. I know I keep doing this. I'm sorry. But look at page 10. The chart on the right, Germany and Italy used to move together like two swans. Their stock markets, their growth rates, pretty much everything. As soon as they instituted the euro, it more or less wrecked, which is the opposite of what it was supposed to do, but it more or less wrecked the economic homogeneity of Europe. And Germany's been zooming ahead, and Italy is moving in the opposite direction. And I don't think there's a solution to this under the construct of a common currency, and I'm nervous about where this leads eventually. You couldn't find two regions or states this different in the United States if you if you checked every possible state combination you could think of. The Silicon Valley versus collapsing real estate values in Florida. A couple of you never ever find these kind of economic divergences in the United States. They're maybe a quarter of the size, and so.
And what you're saying here is the cost of labor is a key driver here between Italy and Germany.
It's less about the cost of labor, more about the productivity of labor. So anyway, the short answer on Europe is this year looks like it's probably going to be a decent year for European equity investments, but that's not a party that you want to stay at for very long. And I would recommend more liquid investments.
In emerging market and debt, by the way.
Yeah. The debt finally is looking a little bit more interesting. It had a pretty tough year last year, and so both the dollar debt and local currency debt finally look a little bit more interesting. but there's 4 countries in particular that are going through tremendous problems: India, Indonesia, Brazil, and Turkey. And growth is slowing. Interest rates are going up. Probably the only 4 countries in the world where interest rates are going up that sharply. And they're having a classic old balance of payments problem. And it feels to me like there's another 12 to 18 months to play out. They took in too much foreign capital, promoted too much consumption. There wasn't a lot of return on all the capital that came in, and now a lot of the investors want their money back. It's a messy process. If you remember, for those of you that have been around for a while, we had the same thing in Thailand in 1998, and we had the same thing in the Latin countries in the 1980s. It's not as severe as that, but the outlines of what's taking place are the same.
As you know, we're a pension fund and we're long-term investors.
Right.
And so you've talked a lot about short-term trends, what your expectations are for the next
Mm-hmm.
year. We're not traders. We can't move around
Right.
to necessarily capture that. So as a long-term investor, what are the longer-term trends that you're seeing? Where is the value today? And how should we position ourselves to take advantage of value as well as long-term trends?
Yeah. To me, what's attractive about the equity market right now, the multiples are, let's say, 14 or 15, right in the middle of a historical range when they've either been overpriced or underpriced. So the valuations look okay, but what's interesting is the markets are pricing in something like 1.5% to 2% real earnings growth. That's the expectation that's embedded, and it's if the markets are basically assuming that the entire world's turning into Japan. Aging population, falling growth, falling profits growth, and I'm typically more of a glass half empty person, but I'm not that glass half empty. I don't think the world's becoming Japan. Japan has a unique set of challenges, whether it's energy policy, demographics, and everything else the United States doesn't have. So from a long-term investor's perspective, I think you would be either at or above your strategic equity weightings right now, and will be compensated for doing so. Okay, so I also think there's an enormous amount of pent-up ammunition in terms of massive amounts of cash on household and corporate balance sheets. There is enormous pent-up demand in the housing market still. Household formation has been running ahead of new home construction now for the last 5 or 6 years. And so if we can get through 2014 without any major problems in Washington, I would expect the U.S. to move back to some kind of post-war trend growth rate in the neighborhood of 3 to 3.5%, which will probably unleash a lot of multipliers across the U.S. economy. So our long-term view is the U.S. should certainly be still the core of a credit, equity, and real estate portfolio, and that the valuations still look good, and that there's a lot of potential good things that can happen down the road. The rest of the world, unfortunately, doesn't have as stable a set of underlying conditions, and a couple of places in particular, governments are conducting policy experiments, the likes of which none of us have ever seen before. So I'm humble enough to tell you that that in some of these places, their strategies are either going to work out really well or they're going to collapse. So it's very difficult to kind of put long-term prognostications on countries that are engaging in those kind of policy experiments. The emerging market surplus countries, Mexico, Poland, the Czech Republic, Thailand, these are the places that are looking like they finally have a set of policies that are durable and workable over the long term and are interesting complements to U.S. investments.
In terms of, let's say, the commodity markets relative to emerging market growth and more stable growth across the world, where do you see valuations there versus long-term?
I rarely see the phrase commodity markets and long-term strategic investor used in the same meeting. But let's do it. Okay, so commodity prices, we have to divvy them up. I mean, there are more differences between commodities than between any two sectors of the equity market. You have precious metals, industrial metals, agriculture, and energy are the four basic sectors. And let's put precious metals to the side for a minute. That's basically a reflection of confidence in the dollar, expectations of future monetary policy. The interesting question for investors is really industrial metals, because that's a better reflection of the global economic cycle. We can analyze supply and demand trends, things like that. China accounts for 50 to 60% of the demand of all industrial metals across the board. So as Chinese growth goes, so does demand for those commodities. And right now, and I could show you this, it's not in the outlook, I'm sorry we didn't include it, but I could show you a picture of the last 10 years, and Chinese growth and commodity prices move pretty much in sync. And China feels like it's slowing, and so I'm not really that optimistic right now on industrial metals.
I was going to say our long-term market forecast for the various asset classes this year, year over year, commodities has the largest or the sharpest drop in expected return for the next 10 years. Those will change every year based upon supply and demand, but that's the area hardest hit in terms of forward long-term view.
Right. I mean, if you talk about long-term expectations, the last 15 years have been characterized by Chinese policy geared towards exports and capital spending to drive growth. And the 5-year plan that was announced last year said, okay, we're going to try and become a more balanced economy. And by the way, the Chinese capital spending boom dwarfs what took place in Germany and Japan after the war and what Korea did in the 70s. It is the largest capital spending boom ever. So if they're telling you we're going to walk away from that policy and try to have a more balanced economy, watch out for what happens to some of these commodity prices. And as it relates to agriculture, I think more people have lost more money trying to anticipate moves in agricultural prices than anything else, heavily affected obviously by not just weather conditions, but by government policy. What's going to happen to government policy on ethanol? Not clear, right? What's going to happen in the fracking debate? Not clear. So we don't have the toolkit to make the kind of long-term assessments of some of those things that you would need.
And just maybe back to your question on long-term. So we manage globally diversified portfolios for clients, in some cases the entire pension plan, and just to compare here, where we do, heading into 2014, we're overweight stocks relative to bonds. We're overweight high yield relative to investment grade. We're short duration elsewhere where we hold fixed income. We are overweight real estate, mostly U.S. real estate. We are using our illiquidity budgets to the full extent that we can. And whether that's in equity or debt, we're making use of that illiquidity budget. So as a long-term, large, fully invested investor at all times, as the police pension fund is, that's how we would compare, strategically speaking, looking long-term.
One of the interesting things that's taken place is how certain markets and market conditions have changed. So to take a little bit of a deeper dive for a minute, look on page 19. So page 19 looks at the credit markets. And if you look at the bottom right chart, it shows you debt issuance by mid-market firms, right? So in a typical recovery, small and medium-sized firms find a lot of money ready to invest in them. There are lots of banks and brokerage firms that cover them and produce research, and it's a very welcoming, accepting market for mid-sized companies. And what's happened due to the disappearance of some of the brokerage firms, some regulatory issues, changes in the market structure, changes in capital requirements, and a bunch of other things, the markets are no longer as accepting of medium-sized companies, but they still need capital. And so there are opportunities in the private credit markets to provide capital to these companies that, frankly, didn't exist before because they didn't have to go to the private markets, they could go to the public markets. And so we can still earn 7, 8, 9% returns by lending to a diversified portfolio of private companies at a time when credit spreads in the public markets are considerably tighter. And so these are the kind of trends that drive where we're allocating capital in different ways. And I mentioned the energy thing. I did want to just show you the chart because you might not appreciate just how big this advantage is. If you go to the next page, on page 20, just you're talking orders of magnitude here. The x-axis on this chart is the price of natural gas, and the y-axis here is industrial electricity prices, for businesses, not for households. And so there are recoveries taking place in some of the other countries on this chart. But if you were to look at GDP growth and payroll growth, anemic though it may feel to you, if we start comparing some of this raw economic data in the United States to other countries, and it looks much better in the United States, and you scratch your head and you say, well, gee, where does that come from? A lot of it has to do with this. And, you have to be careful in what meetings you bring this up because you don't want to start a fist fight. But Germany is actually as the largest competitor in terms of high value-added industrial exports. Germany is decommissioning their nuclear power and is adding offshore wind and solar, at least planning to replace the 20% of the electricity grid that used to come from nuclear. And that is going to raise the cost of doing business in Germany even higher. So these are some of the realities in terms of what's driving the success the United States has had over the last couple of years and where I think we're heading over the next several years. And another welcome piece of information about our industry is, I would say, the last 5 years have been amongst the most challenging years for active managers / stock pickers of the last 25 years. And if you turn to page 22 for a minute, one of the things that tends to happen in a huge recession is lots of indiscriminate selling of all stocks, and then in a recovery, lots of indiscriminate buying of all stocks. And all of a sudden, all the stocks start moving like a flock of geese together. Terrible environment for stock pickers. The chart on the bottom left is showing you the commonality of movement across all stocks. Right? So let's dispense with all the jargon. When that number goes up, all the stocks in the market are moving in the same way, in the same amount, at the same time. Finally, these numbers are starting to come down. And historically, when those numbers come down, the percentage of all managers, not JP Morgan per se, but the percentage of all managers outperforming their benchmarks goes up. So there is no chart in this document that makes me happier than that one. I just wanted to share that with you because I know that you have a mix of both active and passive management in the equity portfolio. There's a longer paper. I don't know who focuses on that in this room, but there's a much longer study that we did on this topic, and if anybody is interested, if you're trapped at an in-law's house for the weekend and you want to read it, I'm happy to share it with you.
Poor Martin.
So I don't know what other topics. I'm happy to cover any other issues or questions that you might have. There's some information in here on the U.S. federal debt, fiscal outlook,
The
municipals.
pension plan is diversified into private equity and hedge funds as well, I think. The outlook for private equity investing relative to its past.
go on,
Yeah.
I saw that you have a section here. Obviously, I haven't had time to read it, so can you just go over that section on Detroit?
Sure.
And the pension plan and
Sure.
the items you have there?
I think the most important question here.
Remember who's here, though.
Yes, oh, I do. I think the most important question here is how different is Detroit from the rest of the country, not with respect to its pension plan, right? Most places, it's amazing what regions and cities can do if they're just moving in the right direction. And there are always tweaks that can be made to pension plans, but ultimately, cities that are having tremendous demographic and tax problems can't support any pension plan, right? Whereas cities that are growing can be more and more generous over time. And the other thing to remember about the peculiarity of the U.S. tax structure is this. States get 85% of their money from income and capital gains taxes. Cities get 85% of their money from property taxes. I mean, most people don't appreciate just how stark those numbers are.
So states get
85% from income and capital gains, and most of the rest of it's going to come from excise taxes and things like that. Whereas the cities get 85% of their tax dollars mostly from property taxes and things related and linked to property taxes. So page 27 here, for me, is the story, which is a lot of people here have probably heard of GDP, gross domestic product. Obviously, there's gross state product, but believe it or not, the Bureau of Labor Statistics also computes gross metropolitan product. So what's happening to the output of the city? Okay, so we got 4 charts here. The output, changes in personal income, what's happening to the labor force, growth, and what's happening to population growth. And the pink wedge is the 95th to 5th percentile. So the vast majority of cities in the United States are captured in that pink wedge, and the blue lines are all the municipalities that we own. The black line at the bottom is highlighting Detroit. And so the challenge for Detroit here is it almost doesn't matter what kind of pension policies they had. A city that's having these kind of labor force and demographic growth issues is not going to have a property tax base that can support anything. So, yes, there are going to be huge fights about prioritization of bondholders and things like that. Look, the Detroit situation is even more complicated. They almost have no unsecured debt. Detroit could write all of its unsecured bonds and loans to zero and still have a massive problem. They have some secured debt, mostly water and sewer debt, and they also have their pension obligations. So this question of should you prioritize bondholders or not is almost irrelevant because you can write it to zero and they still have a huge problem. And so the comfort I get from this chart from municipal investors and as a citizen is that the vast majority of cities in the United States are experiencing growth in personal income, growth in population, and growth in output, right? And at that point, you can tweak whatever the pension issues are and hopefully get them under control. And so but this, you have to look at this to understand just how different Detroit is. And to me, it's a federal issue, right? Detroit at this point becomes a policy issue in terms of what does the federal government going to do in terms of smoothing massive discrepancies as they hit a place like Detroit. And it's not that different from what happened to the textile industry in the Southeast 20 to 25 years ago.
So just to clarify from my perspective,
Yeah.
Detroit is an outlier.
Yes.
Not only did it have economic issues, but it also had governmental corruption issues. I mean, they had a mayor that went to jail and things of that nature. So the issues that were facing Detroit were not being properly dealt with in a timely fashion to coincide with conditions, economic conditions. So, how many do you see? Are there many municipalities in that same situation in the United States?
So the paper that this came from took a close look at this pink wedge and underneath it, and compared a raft of different statistics, and Akron, maybe Cleveland, but aside from those two, there's nothing quite like Detroit. You have to remember, the United States at one point in the early 70s had 85% of the global auto market, and there's no other city in the United States. When you talk about mismanagement, I think when you're good at what you do, you can sustain lots of corruption, right? So I don't think it's corruption. I think the vision was missing, which is if you have a city that only catered to the auto industry to the exclusion of everything else, that was the risk. And the auto industry was very slow to, as we all know in retrospect, adapt to changes in energy prices, right? And so, but at one point, 85% of the global auto industry was in Detroit. And now the big three account for something like 30% of U.S. auto sales. And so, and as that decline took place, not a lot was done in Detroit to attract other businesses. I don't know if this is a good or a bad thing to say.
No.
So you'll poke me. But
I don't know if I can poke you fast enough, though,
yes,
so go slowly.
that's true. If I say it once it's out there, it's like with the jury.
Yeah.
The judge tells you to ignore it, but it's too late. An acquaintance of mine is a guy named Ken Adams, who runs, does anybody know Ken? He runs the Empire State Development Corporation. And, he spends all his time working to try to entice businesses to stay in New York and come to New York for a variety of reasons, and does whatever he can to make sure that it works for the people who work at those companies and everything like that. Detroit never had that kind of strategy, and so you can't all of a sudden, after 30 years, try to adopt one. And so most successful cities have a very aggressive outreach, and there was, for 20 years, so much denial in Detroit that anything was going wrong that they missed their opportunity. Look, upstate New York is becoming a medical research hub. Who would ever have thought of that? But there's medical research facilities going on. RPI is trying to compete now with some of the things that are going on in Virginia and with Houston. And so you have to have people willing to take those kind of risks, right? And some of them will fail. That's why I feel so bad for the heat that the president, I have disagreements with the administration, but I feel terrible about the heat they got for this Solyndra failure. It's venture capital, it's energy policy. 1 out of 10 things is going to work. It's always like that. But doesn't mean you don't do it, right? And the money was specifically allocated to try some of these things and see what happens. So, so Detroit is really unique, and you can't really find any other city in the country that was so linked to a specific industry that its future was written just based on what was happening to that one industry.
On a side note, then you brought it up, about upstate. In this country, we were dominant for many years in creating new technologies. Where are we now? Are we spending money on R&D in any way, shape, or form to a point where we're going to continue being leaders, or we're just ceding that to other countries?
No, the graduate school, tertiary education programs in the United States are still the best in the world. In terms of PhD creation.
Back to countries where, for example, CUNY, like 95% are foreign-born students, and we're getting PhDs in science, technology, and they're actually going back to many of the countries that they came from.
Right. Well,
so I'm just saying
the State Department
we're
encourages
training
that,
them
right?
while we're keeping them.
Yeah. We still, if you look at patent creation, the United States is still in a dominant position in terms of patent creation. A lot of those statistics still look pretty good. Tax policy has a lot to do with it. I would like to see, and I've actually heard people at Brookings talking about this, on a tax-neutral basis, you could probably cut the long-term capital gains rate, but extend the window for short-term capital gains, right? Short-term capital gains, right, you pay the higher rate if it's a year, make it 5 years. But if you create something and it works, have a lower long-term capital gains rate over a 5 or 7 or 10 year period. Those are the kind of things you can do on the margin. But the United States still looks okay in terms of the kind of R&D and intellectual property issues that drive that kind of stuff. We had a
Because that will ultimately, that will pay off over time. We'll have more corporations, more companies, hopefully more employment, working in these new areas. But I'm not sure if we're putting our efforts into.
Most
that.
of
That's why I
those
asked the
numbers look
question.
okay. Most of those numbers look okay right now.
And
What
that's where
else?
private equity would cross into that question. There is still a home for private equity in most long-term institutional portfolios.
Yeah, I mean, the reason people invest in private equity is because not every sector and investment opportunity is captured in the public equity markets. And so the most interesting, if you look back, the most amount of money that you ever earned in private equity, my guess is your experience will be the same as ours, which is you'll say, well, wow, gee, I'm beginning to see a pattern. I made money when I was invested in the kind of things that don't exist in the public markets, right? So the sectors or investment strategies are the kind of things that work best. Where we've had success in private equity is exactly that. And interesting, outside the United States, we've had a lot more success in private equity than public equity in places like Brazil and China. And one of the reasons I'm not super optimistic on investing in public equities in places like China and Brazil, if you look at the market, it's all the state-owned enterprises, banks, airlines, and industrial exporters, but all the smaller, vibrant companies are still private. I think if one of the reasons we all talk about China and Brazil as being interesting is there's this huge growth in the middle class and all this consumption that's happening. Consumer discretionary and consumer staple stocks represent 7% of Chinese and Brazilian equity markets. So if you're optimistic on consumption and you end up buying an ETF or a SPDR in Brazil and China, you're not getting exposure to the thing that you say that you're there to do. And so that's where the private equity markets have actually been more rewarding.
John, can you talk about your rationale when you talked about your overweight on real estate?
Yeah. It's hard to be optimistic about public U.S. equity and in favor of high yield, public high yield, without being optimistic about corporate or commercial real estate, high quality commercial core real estate. Even though, its valuations are up there. We anecdotally, though, would also say there has been, I believe the figure is since the first of the year 2007, $12 trillion created around the globe by sovereign wealth funds or countries that have then turned that wealth into sovereign wealth funds. That money is earning, as we've discussed, very little in short-term investments. And those sovereign wealth operators would like to see a decent return on their capital and are deeply interested in real assets that will throw off an income stream. And there are very few cities around the world, or very few countries around the world.
Well, what's interesting is when I go to see them in Abu Dhabi and Singapore, and they start out saying, well, I only want core real estate. And I'll ask them, what does core real estate mean to you? Park Avenue. Okay. So in 2009, it was Park Avenue. And in 2010, their definition had moved over to 6th. By 2012, they were looking at properties on 8th Avenue, including that Cravath building on 50th and 8th. And if interest rates stay low for another couple of years, they're going to be in the river, right? So the definition of core real estate is expanded. I think the reason from a fundamental perspective, we're optimistic, is every time there's a recession, new construction goes to zero. And you have this period where, as the economy recovers, people are putting more people in the same space. And then you get to this invisible line where all of a sudden you find out the construction numbers are going up and you can't figure out why, because payroll growth has been roughly steady, but what you can't see behind the scenes is that people have been reducing the square footage per worker and getting close to saturating the space they have. And that's part of what's happening right now. And so we track, and I can send you this if you want to see it, we track square footage per worker, and it's almost all the way back. And another 10 or 15%, and you're going to have to start seeing some new construction. Let me show you this will be my last chart, but if you look at the bottom of page 8, this is an important one if you're interested in real estate. The bottom left in page 8 is amazing. There have been 3 booms and busts in the real estate cycle. The first one I refer to as the tax boom, because I don't know if some of the people my age might remember this. In the 80s, they passed a tax act that allowed you to offset active income with depreciation on passive investments. So that's when the doctors and the dentists started buying buildings, and then they changed the tax rules, and then the office markets collapsed. Then you had the tech boom at the end of the 90s, and then you had this credit boom. But where we are now is there's almost no new construction going on. And as businesses are growing, they're using the same space and infilling and infilling and infilling. And by the end of this year, I would expect to start seeing so much demand and rental growth that you'll see some new construction. And the same thing happening in the labor markets. The work week is at the highest level in about 50 years. Right? So what's happening is payroll growth is slow because over the last few years, the people that are working are being asked to work longer and longer and longer weeks. Unless you can turn people into robots, we're getting pretty close to the point where the work week's not going to be able to go up anymore, and you're actually going to have to start higher. So,
6 days is not enough. Only 7 days. Do more with less. Do more with less.
And companies have. But I think 2014 is where people are going to start recognizing, okay, we can't max out our real estate space anymore. We're at the end of being able to increase the work week, and we're going to be spending a lot of this accumulated cash on hiring and new investments. But every time this real estate cycle has happened, the best time to invest is after construction goes to zero, because at that point, you don't have lots of new supply.
In your fixed income portfolio, other than being overweight, high yield, what are you doing to protect the portfolio as rates start to go up? How are you going to generate return? We're struggling with the same kind of thing.
You know,
Depends on the portfolio, right?
Look, fixed income portfolios are unfortunately captive to bond math. And there's not a lot that you can do. So there's a few different things to think about. One is you can try and add yield through higher yielding strategies like private credit. And the second one is at the right time in the cycle, perhaps you can reduce the duration of the portfolio. But I think when you look back at 94 and some of the other periods when the Fed raised rates and long-term rates went up, there's a period of 12 to 18 months where fixed income just doesn't generate much. I personally think it's a little late in the cycle to make radical reductions to fixed income duration now that we've already had the first leg of the bond marketing. So, and the vast majority of institutional clients had made their peace with, we're going to have a segment of the portfolio that is not generating any real return.
And it's going to lose money.
Sorry?
And it's going to lose money.
And it's going to lose money for some period,
Right.
but it's too disruptive to try to make radical surgical reductions. There are clients that have moved from 4-year duration strategies to 2-year duration strategies, that have moved from high yield to high grade to try to wait it out. But there's not a lot of easy answers. There are more opportunistic managers that can use 15, 20, 30% of a portfolio to use credit default swaps and other things to try and add income. But to me, it would make more sense to enhance the returns in the non-fixed income part of the portfolio, except the fact that there's going to be a repricing. Look, this has been the largest intervention by the central bank specifically to drive the real returns negative on fixed income since the creation of the Federal Reserve in the early 1900s. And so there was always going to be this catch-up period when they were going to have to reprice somewhere closer to fair value. We had a period of, I don't know if it was last year or the year before, the Fed in the secondary markets ended up purchasing 80% of the Treasury issuance. I mean, it was, we've never seen that before. It's like going to the prom with your sister, right? I mean, normally the central bank is not supposed to be supporting the fiscal activities of the Treasury. And so there was always going to be this period when the Fed steps away of having the markets have to reprice. But something tells me that we're 50 to 60% of the way through that process already.
Those long-term forward returns I was talking about would have, depending upon the senior fixed income investor you might talk to, the long-term equilibrium for the 10 years at 4% to 4.5%. So we're getting closer.
Yeah, okay, so what's really interesting is when people see that, they say, oh my goodness, what's going to happen to housing? And if history is any pattern, interest rates are going to go up to those levels at a time when growth is returning. Payrolls are going up, wages are going up, and household demand is going up. And so you're not going to have interest rates rising in isolation in an environment where the housing markets are completely not suited to absorb. And there has been a rising yield curve. So with rising short-term rates and rising long-term rates rising even faster, 19 times since 1950, in 18 of them the equity markets went up. Because that kind of yield curve action is typically only taking place coincident with an economic recovery. So there's historically been a lot of misunderstanding about what those rising yield curves means. It's not the same as when it happens in Venezuela, right? When the yield curve is rising because people are trying to get the heck out of Venezuela and they don't want to own any of their assets anymore. So I would view an eventual and gradual move higher in interest rates as a signal that things are finally getting back to normal. Certainly the endowment and foundation community is desperate for that to happen. So I thank you all very much for your time.
Thank you for the opportunity.
I hope somebody edits the...
No, you're
okay.
on. That's it.
It's done.
Instigated.
It's memorialized.
He didn't hit you in the ribs
There it is.
enough. That's what happened.
Thanks again, everybody. Enjoy the rest of your meeting.
Thank you very much. So that was all we had on the agenda. For the public session.
Was it?
Yeah. In executive. Yeah.
So to go into executive session?
Sure.
So make a motion that we leave public session, go into executive session.
Second.
Great. Cameras off.